Your 20s are a time when you first start making money, and it's very common and normal to be dumb with your money because, well, it's the first time you ever make money. So now you want to go out and buy the nice things. You want to start spending money. You want to start going on vacation. You want to start buying a nice apartment. You want to get a nice car, and you want to just start exploring and enjoying life because you're finally out of school and you're finally making some money. But then come your 30s, and now you think this is going to be the time that I'm going to become wealthy, and an interesting thing happens in your 30s. First, this is around the time where a lot of people start to get married. You want to start settling down. Now, if you haven't gotten married yet, or if you are married, you know getting married is expensive. Not just because it costs money to file the court work, but because weddings are expensive. Now, I come from a traditional Indian family where Indian families and Indian weddings are extremely expensive because Indian weddings don't last 8 hours. Indian weddings last a week, if not longer. So, very expensive to get married. Then you consider having kids. Kids are also expensive. Now, I don't have any kids yet, but I have a lot of friends who have kids, and I hear about the financials of having kids, and having kids is expensive. Then you want to buy a home, if you haven't already. Buying a home is expensive. You need money for a down payment. You need money for the upgrades. You need money for the maintenance. You need money for all the nice things and the furniture that you want to put in the home. And then you start thinking about your college fund for your kids. And then you start thinking about building wealth for yourself and your wife or your husband. And then you start thinking about planning nicer vacations. And now because you're older, you also want to eat at nicer restaurants. And now because you're older, you want to have these fancier parties, go on these fancier dates. And now because you're older, you also want to drive a older person car. And now because you're older, you also want to have the nicer clothes so you look a little bit more professional when you go out. And now all of a sudden you're in your 30s, you're establishing yourself in your career, you're making okay money, but if you don't have a plan going into your 30s, it is going to be very difficult now all of a sudden to start building wealth and managing your money because life happens and life is expensive. And people have a lot of babies, and every baby is going to have a baby shower, and every baby shower is going to have an expensive gift that you got to give. So if you don't have a plan going into your 30s, it's going to be very hard to build any wealth in your 30s, which is why so many people in their 30s are still struggling financially. And that's why now, if you want to become wealthy, the first thing you got to do is you got to build a plan for your money. Now, I know a lot of people out there are saying, oh, you just got to make more money. That's going to fix your problems. But the reality is, we've seen this statistically, is when you make more money without having a plan, you dig yourself into a bigger financial hole. How do we know this? Well, just look at people who won the lottery. People have won millions and millions of dollars. Yet the majority of lottery winners end up broke or bankrupt within 5 years of winning the lottery. Why? It's not because millions of dollars weren't enough. It's because you don't have a plan for your money. And this is where the first thing you have to do is be comfortable and okay with the money that you have right now, and that starts by making a plan. Now, one of the simplest things that you can do is follow something like my 75-15-10 plan, which says for every dollar that you earn from here on out, 75 cents is the maximum that you can spend, and that includes gifts for baby showers. 15 cents is the minimum that you're investing. 10 cents is the minimum that you're saving. Now, you're going to be saving money up until you can hit your savings goal. And your savings goal is going to be somewhere between 3 months to a year's worth of expenses. So figure out what your monthly expenses are. Take that number, multiply it by 3, multiply it by 12. That's the range of how much money you want to save. If you don't have a big risk tolerance, if you really like to be on the more cautious side, then you can save 6, 9, 12 months worth of expenses. If you want to be more of the risky side, you don't mind having less savings, then you can save 3 to 6 months worth of expenses. But now, once you figure out how much money you got to save, work to save that money. Once you save that money, take the 10% that you were allocating towards your savings, stop saving, and take the money and invest it. And the reason why I want you to invest that money instead of spend that money is because your wealth, your richness, your financial freedom comes from your investments. It doesn't come from your savings. It doesn't come from which car you drive or what home you live in. It comes from your investments. The more investments you have, the wealthier you will become. So I want you to reallocate that money towards your investments. Now, you can invest this money into stocks. You can invest this money into real estate. You can invest this money into your own self, into your own financial education. You can invest this money into your business. You can invest this money to pay down some of your debt. There's a lot of ways that you can invest this money, but the key is that you're going to put this money to work. That way it can make you more financially free. Paying down your debt will make you breathe easier, But if you want to be completely financially free, you need assets. You need investments that are going to pay you, because when your investments are paying you enough to cover your expenses, now you're financially free and you don't have to worry about money. If you have a dividend portfolio, dividends are cash flow the stocks give you that are paying you enough to cover your mortgage and cover your expenses, you don't got to worry about money. You don't got to worry about clocking in tomorrow. Now, that doesn't mean you shouldn't go to work, but you don't have to stress the same way about money that you would be if you didn't have that. So the goal is to own enough investments that will cover your lifestyle. But in order for you to do that, you have to be able to invest your money. So that means, number one, wherever you are right now, no matter how much money you're making right now, you do not spend more than 75 cents of every dollar that you bring in, period. Now, you might be saying, but Jaspreet, my best friend is getting married next month. I need more money for a gift. I need more money for a bachelor party. I need more money for this or for that. It's life. There's always going to be things happening. What happens in your 30s is people keep popping out babies, people keep getting married, and people keep having expensive parties at these overly over-the-top restaurants that are expensive. And what you realize is you start going to these nicer restaurants, and you start getting smaller portions of food. It still makes no sense to me. But that's what happens in your 30s. You pay more for less food, and you pay for a lot of people's babies. That's the 30s. That is life, which is why now you got to stop with the exceptions, and now you got to start being smart with your money today. That means now 75 cents is the maximum that you can spend. Now, if you want to be able to spend more, because now you want to have nicer things, you want to be able to have a bigger lifestyle, okay, that's fine. Nothing wrong with that. You're either going to have to A, invest more so you have more income coming in from your investments, or B, you're going to have to work to earn more money. Now, going back to what I was saying just a minute ago, statistically, when people make more money, they dig themselves into a deeper financial hole. Why? Because we're not given any sort of financial education. Most of us don't know what to do with our money. Most of us don't know what to do with $1 million if we were given it. Most of us don't know what to do with an extra $10,000 a year. And the quickest way to increase your wealth is next time you get a pay raise, don't inflate your lifestyle. Next time you get a pay raise, don't raise your lifestyle. Make more money. That way you have more money to invest. Now, I'm not saying you got to live like you're broke forever, but you got to go through this period. I call it a decade of sacrifice, where you're going to be working to do two things: earn more and spend less. That way you have more money to invest. Now, it doesn't sound like a lot of fun, and cutting back isn't the most fun thing to do, but if you can make it a challenge, it becomes more fun. But it will allow you now in your 30s to build way more wealth. That way, once you hit the 40s, because guess what? The clock is going to keep ticking, years are going to keep going, and time is going to keep running. And eventually you're going to become 40. You're going to hit your 40s. And now either you can be in the same situation that you are right now, or you can work right now to put in the sacrifice to build that wealth. That way now once you hit your 40s, you've built a solid investment fund, you've built a solid investment portfolio that gives you a lot more financial freedom. And now you can start spending more money because you can afford to. And now you can start going to parties and be a lot more comfortable spending money. But that requires you to put in that sacrifice today. Either you're going to put in the sacrifice today, or you're going to pay the price tomorrow. I mean, the choice is ultimately yours. But the reality is, if you want to be able to manage your money like the wealthy, the first thing you have to do is you got to be able to make the sacrifice to live a little bit smaller, and then work to earn more money. But then when you work to earn more money, don't work to earn this money now that we can drive a faster car or have a bigger home and go on these nice vacations, or pay for the small portions of food at these expensive restaurants. Work to earn more money right now. That way you have more money to invest. Period. Put in that work to invest your money first. Make yourself rich before you make everybody else around you rich. And what that defines to in number terms, whether it is $100,000 or $500,000 or $1 million, that's subjective. That's for you, depending on what your lifestyle is and how much money you need. But you have to be willing to put in that work right now. That way you can actually build that wealth. And this is where now you want to be looking at your money. And the simplest way to do this, I want you to take a piece of paper. I started doing this with everything, is when a new month starts, take a look at last month's finances. That means I can do this on a Google Sheet. You can do this on a piece of paper, whatever you want. You take a look at how much money you brought in. This could be money from your job. It could be money from your business. It could be money from your investments. Take a look at all the money you brought in. At the top, write the income. Then write the total money that came in. Then write down where that money went. So you can write how much money you saved. Write down how much money you invested. And then write down all of your other expenses. How much money went to eating out? How much money went to groceries? How much money went to traveling? How much money went to housing costs? How much money went to gifts? And how much money went everywhere else? Now you write down your expenses. Now, as soon as you do this, you are immediately going to find ways to adjust and improve how you're using your money. How do I know this? Because as soon as you see how much money you're spending on a bunch of expensive meals that aren't feeding you properly, you're going to immediately want to make changes because it's going to be staring back at you in your face. So start quantifying where your money is going and take a look at it. And now when you look at it month over month over month, you're going to see how much money you're bringing in, if your income's growing, staying the same, or falling. You're going to see how your expenses are doing. Are you spending more money, spending less money, spending the same amount of money? And see where your money is actually going. Sometimes, yeah, there's going to be months where you have to spend more money. That's life. But if you don't have to spend money, do you have to spend money? And this is where right now, your job as a financially smart person is to stop following what everybody else does, because the reality is most people in the 30s are still broke. Even if they're driving a BMW, they're still broke. This is where now you want to be the person that's not broke driving a BMW. You want to be able to afford the BMW and not have to stress about putting premium gas in the car. It blows my mind how many people have BMWs or expensive pickup trucks that complain about gas prices. If you're complaining about gas prices, you shouldn't have that car to drive in the first place. If you're complaining about the premium gas price, you shouldn't be driving a car that takes premium gas. Period. And this is where, if you want to have the nice things, cool. Just make sure you can afford the nice things first. And the final thing that you have to do in your 30s, you have to do this right now if you want to ever have a chance to ever become wealthy, is if you have a partner, a wife, a husband, a spouse, you got to sit this person down and get on the same page financially. And I get comments about this all the time. Jaspreet, I'm working hard to build my wealth, but my wife keeps spending all my money. Or, Jaspreet, I'm working hard to build wealth, but my husband keeps buying all these stupid cars. What do I do? Talk to them. Can you do something? And this is where now you got to sit down with your spouse and have an honest conversation about money. Show them my videos if you want, but you got to have an honest conversation about money, about where you are today and where you're trying to go. And the way that you win in this conversation, I'm going to tell you from personal experience here, is not to say, hey, wife or husband, we're going to cut back on expenses because cutting back is fun. That never works. It's, hey, husband or wife, we are going to make some sacrifices today. Work with me on this because I think you're going to be able to have even more fancy handbags 5 or 10 years from now, because we're going to put this plan together and we're going to work together to build more wealth. That way you can buy whatever handbags you want and not have to stress about the price. So now you're working towards a goal where, okay, you want some nice things. That's fine. That's very common in a relationship where one person likes spending, the other person doesn't. Opposites attract for a reason. Very rarely do you see two people in a relationship that are both like, you know what, we're going to cut back on expenses or we're going to earn more money. It doesn't work like that. One person wants to make more money and one person wants to spend more money. It's just how it works. Now, in order to get on the same page, you got to get together on the same goals. It's easier to align on the goals and then put in the sacrifice together. And this is where you're going to have to be honest with one another and come together with a game plan and work together to come up with an actual system to build wealth together. Hey, wife, husband, we're going to work together. That way we can invest more. That way we can save more. That way we can build a financial future. That way we can build a college fund for our kids. And as we start to do this, we're going to be able to spit off this much money every month for fun and discretionary items and more handbags or whatever it is that you want. And then in X number of years, we're going to be able to have more fun, go on more vacations and do this type of stuff. But I need you to work with me. That way we can actually make this happen. I'm going to jump back into the video in just 1 second. But before we do, if you are an investor and you're looking for an easy and free way to stay up to date on what's happening in the top financial news, from the economy to the housing market to the stock market to the crypto market to the global economy, then you have to check out Market Briefs. Market Briefs is my free financial newsletter that I created that will keep you up to date on what's happening in the financial news. You can read the newsletter in less than 5 5 minutes every morning. It's a fun and easy to read email, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below. And this is where you also want to understand and remember that if you're in your 30s, you are still young. You have so much time ahead of you. If you're in your 30s, if you're 35 years old, you are young. This is still the time for you to be aggressive. There's a lot that you can do. It kills me when I hear people who are 35 years old talk about how they're stuck in their careers or they're too established in this one industry and they cannot change. You are so young. If you want to make a change, do it. There's nobody stopping you but you. Now, you might feel like everybody's watching you. Your parents are watching you. Your in-laws are watching you. Your friends are watching you. Your cousins are watching you. Your coworkers are watching you. But who cares? This is your life. Everybody's going to judge you. The world is built to judge. That's just the way it works. Anytime I release a video on YouTube, people will judge. People judge no matter what you do. People will judge based off of what clothes you wear. People will judge based off of how much facial hair you have. People will judge based off of what pen I use. People judge me based off of what tea that I drink. People will judge you for everything that you do. People will judge you if you stay at your job. People will also judge you if you leave your job. It's just the world. So now you might as well make it matter. You might as well make it worthwhile. So if you want to make a change, if you feel like you're unhappy financially, go out and make a change. That might be making sacrifices with your car, making sacrifices with your home, making sacrifices with your vacations. It might be making sacrifices with the career that you're doing. But you are the one that's in control of that. You're the one that's in control of your life. And if you're constantly worried about what other people think, it is going to be impossible for you to ever achieve any real financial freedom. And the one thing, there's a lot of things that I can credit, and I'm very fortunate to be where I am, and I know that. But I would say the main mindset thing that allowed me to be where I am today is the fact that I was stupid. I never cared what people said. No matter how many dumb things I did, everybody told me that I was being dumb. But I had that hard head where I just kind of followed what I thought was right, no matter what. So please, if there's one thing that you get out of this video, it is to stop working to please other people and work to please yourself. Because the reality is, nobody else is going to be the one that's dealing with your bills. Nobody else is going to be the one that's paying for your kids to go to college. Nobody else is going to be the one to pay for your spouse to have the nice handbags or to pay for your family's vacations. That's you. Now, everybody else is going to talk no matter what. Everyone else is going to be talking about what you're doing or what you're not doing or what you should be doing. So give them something good to talk about. So now, if it's your responsibility to take care of your family, take care of them. Take care of yourself financially, take care of your family financially, because that is your duty. It is not your duty to worry about what everybody else thinks, because everybody's got an opinion and everybody's got something to say. It is your duty to take care of yourself, your family, and your community. And when you're in your 30s, you are young. You can still be aggressive. You can still go out and do bigger things. You can still go out and make big changes, but you have to be the one to go out and do it. So now, if you are in your 30s and you want to build wealth, the first thing you got to do is figure out how far are you from becoming wealthy. Then number 2, put a plan in action to actually become wealthy. That means now take a look at how much money can you put aside every single month? How many years do you have to work ahead of you? 3, put a plan in action to actually invest this money. Put a plan in action to earn more money if you need to. Put a plan in action to spend less money if you need to. And then think a little bit bigger. This is the minority mindset. We're not here to think like everybody else. If you want to think like the majority, go watch any other channel. The whole idea here is to think different, that we don't have to live an average life, that way you can live a bigger life, but that means you're going to have to start thinking differently than the majority of people. Now, if you want to start thinking differently than the majority of people, that means you're also going to have to do things a little bit differently. That means you might have to make a little bit more sacrifices. That means you have to work a little bit harder. That means you might have to work a little bit smarter. But it will also allow you to live a life that most people dream of. Now, again, most people are going to talk and judge and hate on whatever you do, no matter what you do, whether you don't change or whether you do change. And so now, if your goal is to live big, at least give everybody something to talk about, something good to talk about, because now if you stick with it, you're going to be able to earn more money. And now you know what to do with this money, because now you can take this money and invest it and build your wealth, build your family's wealth, and take better care of your family. And now people have a better reason to talk, because now you can take better care of your family. And it doesn't matter because their opinions are not paying your bills. Your money is. And now you can have the nicer things and have more financial freedom because you work to earn it, and you're not going to complain and blame everybody else. You're just going to continue to put your head down, get your money, that we can take better care of yourself, your family, and your community. If you want to be a high earner or a high achiever, it starts with your mindset. And what I want to do now is go over 10 mindset shifts that you can start making today that all high achievers are doing. And number one is the blue ocean mindset shift. There's a book out there that I highly recommend you read called The Blue Ocean Strategy. And what the Blue Ocean Strategy talks about, this is mainly in terms of entrepreneurship, but you don't have to apply this to entrepreneurship. You can do this even if you work a job. But what the Blue Ocean Strategy is, it says that the majority of businesses out there are operating in what's called a red ocean. It's a bloody ocean where businesses are competing against each other to do the exact same thing. People are just trying to make a little bit of a better mousetrap where you're selling the same product that somebody else does or a copy of somebody else's product. Maybe you try to compete on price. Maybe you try to compete on speed, but you're competing on little things where essentially you have the same business as somebody else. You're direct competitors and you're trying to undercut the other competitor. So you have this limited market share, this market space. And now the companies there are working head to head for the exact same market share, the exact same market space, and it's a bloody competition to essentially the bottom. And what the Blue Ocean Strategy is, it's how can you go from this bloody red ocean to a blue ocean where you have a wide range of opportunities and little to no competition. This is what the Blue Ocean Strategy is. An example of this Blue Ocean Strategy at work would be comparing the old Blockbuster and Family Video, where you had all these movie stores that were competing against one another for your Friday night movie rentals. And then came along Netflix, another DVD rental business. But instead of having a place where you would go to rent a DVD like every other DVD rental business out there, they started off by mailing you the DVDs, and then they started investing in their own technologies to create a movie streaming model. A completely different business model than all the traditional movie rental businesses out there. They created their own market share. They created their own business strategy. They were selling the same thing, movies, but through a whole new market. Because now they created a whole new market of people who wanted to stream or get access to movies on their own terms instead of going to the Blockbuster, instead of going to Family Video. And it was a whole new business model, and they eliminated all their competition. A completely different business model of doing something different. So now, if you want to be a high achiever, the question is not how do you go out and build the next Netflix, but how can you play a game that isn't competing against everybody else, doing what everybody else is doing. Because if you do what everybody else does, you're fighting for a small pie. But if you can start innovating and hustling a little bit smarter, now the question is, how can you create your own success doing something a little bit different? So if you have your own business, the question is, how do you create your own blue ocean? And if you are working to build your own wealth, again, this is the same thing, thinking differently than everybody else. Everybody is working to get a paycheck so they can drive a bigger and fancier car. But if you really want to have the bigger and fancier car without having to worry about the price, you got to create your own income. And if you don't want to go out and create your own business, that means you got to go out and invest in other investments, other assets that will pay you, that way now your assets can pay for your car. The second mindset shift that you have to make is going from a scarcity mindset to an abundance mindset. Most of us, most people have a scarcity mindset where we think there's a limited amount of money in the world. There's a limited amount of happiness in the world. And so if somebody else is successful, if somebody else has money, if somebody else is happy, I should hate them because they're taking away the limited amount of success or winnings in the world. When in reality, there's a lot of money in the world. And there's no limit to how much happiness that's in the world. Like, you can be happy and I can be happy. But the problem is when somebody is unhappy, it's very happy to be happy for other people who are happy. Just like that, when somebody's broke, it's very hard for a broke person to be happy for somebody who did get that money. But this is where, again, it starts with that mindset. There's no limit. There's no scarcity of money. There's a lot of money in the world. Yeah, do some people have a lot of that money? Sure. But there's no limit to you getting a piece of that money too. What you have to do is figure out how can you create some value that we can get a small little piece of the money that's in the world. And just like that, happiness is in abundance as well. Now, this is not a mental health channel or topic, but if you're struggling emotionally, you're struggling with anxiety, depression, you're struggling to feel happy, it's not a money thing. More money is not going to make you more happy. More money gives you access to do things that will make you happier. But if you're not happy, you got to go figure out what it is that's making you unhappy. And if you have something deep down, you have issues, mental issues, go get that taken care of. Talk to a therapist, talk to a psychiatrist, talk to a psychologist, do whatever it takes to take care of that, because one of the most painful things that I've seen people realize is that more money is not the solution to make you happier. And when you chase money to chase happiness, and then you get that money, but you don't get the happiness, you get an even deeper and darker hole inside of you. And that's where you got to understand that if you want to be happy, that's different than getting money. More money can allow you to do more things that make you happier, but it's not just going to make you happy all by itself. Number 3 is the work to learn, not the work to earn mindset. And this is a big mistake that so many people make, is that they work to get jobs solely for the purpose of making money, solely for you to go out and buy the nice things. But if you really want to be able to scale yourself, whether it's in your career or in your business, you have to be willing to work to learn, not just to work to earn. That means you have to be willing to go out and maybe get a job where you're not making as much money as you were before, but because you're going to learn a skill, you're going to learn something, you're going to learn a value, a skill that is scalable that you can apply somewhere else. Or maybe you're going to work in a company or in a place where you have more scalability, but it requires you to build the long-term mindset of, now I'm working not just to get a paycheck. And this is so hard because most of us are taught when you go get a job to just look at the paycheck. How much money are you making? What is the salary? But real wealth, if you really want to build wealth, that means you're going to have to work to learn, not just to work to earn. One of our newest hires here at Briefs Media talks about this all the time, because he talks about all the crap that he had to go to in other places because he didn't know anything about digital marketing, digital business, and he would work for these other brands just to learn. He started off, he got roles with big digital brands because he offered to work there for free. He got his foot in the door. Then he got to meet other players in the game, and he offered to work for very cheap. And he had to make a lot of sacrifices to do that. But the reason why he did that wasn't so he could make a lot of money in those positions, but so he could learn. That way he could then go to the next person, to the next brand, and show, hey, this is what I've done. I've done X, Y, and Z. I've learned these things. I've learned digital marketing. I learned how to work with people. I learned how to advertise. I learned how to sell things. I learned how to work with brands. And now because I've done all of this, I built up this huge resume of skills and experience. Now he has the ability to earn way more money because he was willing to work to learn first. 4 is building a long-term mindset. And this one is so difficult because when you grow up with this idea of instant gratification, it becomes extremely difficult for you to see any real success in life, because now all you want and all you see is that instant success. You see people who became rich overnight and you wonder, why can't you have that too? And then that's what you start doing. You start to follow the get rich quick schemes and systems. Now maybe you throw your money into a meme stock, think you're going to get rich, and then as soon as you buy, that's the stock that goes down. You find a cryptocurrency that's on the way to explode, you buy it, you make a little bit of money for a few weeks, and then it implodes and you lose your money. You find a new course or system that's going to show you how to make 6 figures in 6 months. You buy the class and 2 weeks later, you stop taking it and you realize this is not going to teach you anything valuable. Your money's lost there. It's a game where you constantly keep getting lost in that track, when in reality, real wealth is built over the long term, over any sort of whatever you want to call it. I mean, with your investments, investors will beat out the traders over the long term. Traders might win in the short term, but the investors are going to win time and time again over the long term. But that requires you to be investing into an asset for years, if not decades. Building a business is a lot more profitable than starting a quick side hustle that's going to make you a lot of money. But it takes a lot more dedication and sacrifice and risk today to do that. learning from a class that's going to teach you how to build wealth or invest your money isn't going to be as attractive as 6 figures to 6 months, but you might actually learn a skill like real estate investing or money management or building a business or other skills that will allow you to actually scale your income, but it's not going to be as attractive as everything else. And this is where, unfortunately, getting rich quick is a lot more attractive than getting rich slowly. But getting rich slowly is a lot more of a surefire way to actually get rich. And again, if you want to get rich faster, you got to put in more effort, you got to put in more work, you got to take on more risk and try more things in order to do it. But ultimately, you have to have the long-term mindset of, I'm willing to do whatever it takes, whether it takes 1 month, 10 months, or 10 years to go out and get there, because it's a lifestyle change as opposed to just, I'm going to do this for 6 months and see what happens. Number 5 is you got to adapt the growth mindset. And this one is so hard because many of us, or a lot of people in general, like to count other people's pennies, and they're more worried about what other people are getting rather than what they get themselves. And what you'll see is that people are so focused on what other people are getting that they would rather you not become successful than they become successful themselves. And you see this in so many different industries, in so many different ways. I remember when I was in college, I was working as a realtor. I was working with these clients who wanted to buy this home. They were very difficult clients, showed them home after home after home after home after home. Finally found them this home that they loved, that they liked, that was within all of the specifications. We're ready to make the offer. We're working on the contract. And I don't know how many weeks or months this is into us working. And the husband and wife who wanted to make this offer sit me down and they say, Jaspreet, okay, we want to put this in the contract. There's only one thing. I said, what's that? They said, we want you to put half of your commission into the deal. We want you to give us half of your commission. I said, why? Again, I was in college. I think I was going to make about $12,000 to $15,000 in commission on this one deal. And they said, we don't think that a 20-year-old deserves this much of a commission, so we want you to give us half, essentially. Now, I was a hard head back then. I didn't really negotiate or talk, and I said, nope, you can do it yourself. And I walked away. They were more worried about what I was going to make as a broker, as a realtor in this deal. They knew exactly what my commission structure was. Before we even began working together, they had to sign paperwork which said that I was going to split the commission with whoever the sellers were for the property. The money wasn't coming out of their pocket. It was coming out of the seller. So they knew exactly what was happening, but they waited until the last minute because they felt like I shouldn't be making $12,000 to $15,000 off of that one deal. Well, I walked away and they lost the ability to get that home. And so this is that growth mindset of now understanding I need to focus on me, not what everybody else is, and I can have more. It goes hand in hand with that abundance mindset that I can have more money, I can have more success, I can have more happiness, and me being successful is not going to hinder somebody else from becoming successful. You can become successful and I can become successful. You can be happy and I can be happy. You can be healthy and I can be healthy. There's no limit. And this is that growth mindset of, wow, we can all win, but I have to be able to believe that we can all win. And this is that, it's just a different way of thinking when you start to realize, wow, being a hater doesn't do any good for anybody. It doesn't help them, it doesn't help me. In fact, being a hater might help them and it might hurt me. So me hating on somebody else might give them more fuel to want to succeed, while it just keeps me in this negative, like just toxic environment that I'm swimming in, and I'm creating that toxic environment myself. Number 6 is ignore what other people think. And this is so difficult for so many reasons because I can tell you from the traditional Indian culture, this whole idea of what will other people think. I mean, every immigrant brown kid has heard their mom and their aunt and their grandma and maybe their grandfather and their parents and their dad talk about how, oh, what are other people going to think if you do this? What are other people going to think if you act like this? What are other people going to think if you wear this? This is like one of those things. This is one of those sayings that you just hear again and again and again. In Punjabi, they say, oh, ki kahange, lok ki kahange. That's the way that they say it in Punjabi. And it's one of those things you're so bred to hear that you're always worried about what other people will think. And I heard it so many times that I became so fed up with it that I stopped caring completely. That I was like, you know what? Let me go out and give people a reason to talk about me. You get so fed up with that. And when it comes to money, what other people think, oh my God, people love talking. This is what, again, people, this is what they do. but this is not going to pay your bills. People love talking about you, but it's them talking about you is not going to pay your bills. So if you downgrade from a BMW to a Toyota Corolla, you bet everybody's going to be talking about you. Let them. It's not going to do any different for you. It's not them talking is not going to pay your bills. Them talking is not going to send your kids to college. Them talking is not going to pay for your wife's vacations or whatever she or he wants. You got to stop worrying about what other people think if you want to become successful or happy or really anything in life. Because when you're so worried about what other people think, you become a slave to other people's opinions. And you got to be able to break out of that. Financially, that means when people see you downsize, they're going to make fun of you. But that also might require you to do some things that, people might think you're weird. When I was in high school, I started playing this Indian drum called the dhol. And being an entertainer or working in the entertainment business, in the traditional Indian culture, is like something that low-class people generally have done. And so when I would go and work at these weddings, playing dhol, you would run across traditional-minded people like that wouldn't even want to make eye contact with you because they would consider you such a low-class person, almost like not even a human, because you're just working in the entertainment business. Now, we were having fun. Like, we were high school kids, college kids, working at weddings, having a good time. We were making decent money. But you would find people that were just so stuck on this idea of status and pride that they wouldn't even want to talk to you. There was one event that me and my friends were working at. We were waiting to play the drum. And there was this elder gentleman there who didn't want to come up to us and tell us to start playing. Instead, because we were so low class as the entertainers, the drum players, he had a bag of pennies and nickels. He stuck his hand in the bag and would just start throwing pennies and nickels at our faces, saying, essentially, get started. That way he wouldn't have to speak to us. And so this is where, if you're so focused, if I was so focused that, oh my God, what are people going to think of me if I do this? I would have never done that. If I never played that drum, I would have never gotten to know the DJs. If I never got to know the DJs, I would have never entered the event planning business. If I never ever entered the event planning business, I wouldn't have money to start investing in real estate when I did. If I didn't start investing in real estate, I wouldn't have become a realtor. If I didn't become a realtor, I would have never gotten involved with wholesaling real estate. If I didn't start wholesaling real estate, I would have never gotten involved with the internet and e-commerce because that wanted me to go into that industry. If I'd never gotten involved with the internet and e-commerce, I would have never ended up here on YouTube. So you got to be willing to just do what's right for you. The world loves talking. Go look at any Facebook ad or Instagram ad. What do you see? People hating. Because people hate when other people are trying to do something, trying to succeed, trying to achieve their dreams. Why are people running ads? Because they want to grow their business. People hate it. And it's just the way the world is. So let people talk. They're going to talk. That is what people are professionals at. But the haters are not going to be the ones that are paying your bills. So at least give them a good reason to hate. Number 7, make yourself replaceable. And this is, again, whether you're an entrepreneur or whether you work for a company. If you work for a company, guess what? You are replaceable. No matter how good you are. You could be the most valuable employee at the company. And that's a very good thing. I'm not saying don't make yourself valuable. But what I'm saying is also have that value of replaceability for yourself, because if you were to die or if you couldn't go into work tomorrow, and I know this is very dramatic, but if something happened and you couldn't get into work tomorrow, your company would have an ad out to find a replacement tomorrow, the same day, especially if you're very valuable. Now, again, I'm not saying don't make yourself valuable. You need to work to make yourself valuable. That way you can make the most money, provide the most value, learn the most things, and have the most ability to scale and grow within the company. But everybody's valuable. Even the CEO is replaceable at a company. But when I say make yourself replaceable, what I mean is you got to do something to make sure your family is still taken care of if you can't go into work tomorrow. Because if you don't work, you're not going to keep getting paid. And this is where now owning the assets is so important. Owning the rental properties, owning the stocks, owning whatever it is, your investments, having that wealth cushion. And it's not going to happen tomorrow, but it might happen over the next decade where now you're working to make money. That way you can own these assets. That way, if hopefully nothing happens, but if something were to happen to you, your family is still okay. That's what I mean by making yourself replaceable. Same with your own business. If you are an entrepreneur, you have to make yourself replaceable. in a company. If you are not the best CEO for your company, you want to fire yourself and bring on a new CEO. Yeah, you still own the company, and that's the point, is you want to grow the profits. But if you're not cut out for it, bring somebody else on. And if you want to really be able to build a real business that you can sell, you have to make yourself replaceable. That was one of the big mistakes that I made in my early businesses, because I had no idea what a business was. I just created a job for myself. And it was cool. I was making money. But if I wasn't working, I wasn't getting paid. And so if you want to make yourself replaceable in a business, that means you have to be able to pluck yourself out at some point. That's how you build a real business. It's the same thing whether you're working a job, whether you're working a business. You have to make yourself replaceable financially. That way, if something were to happen, the finances of your family can continue to survive. Number 8, plan for the worst, prepare for the best. And this is a mindset shift because, well, things will go wrong. It's life. And you want to make sure you can understand that, but also be able to capitalize on that. So what does that mean? Let me give you some real life examples. Recessions happen. They're a part of our economic system. We've seen recessions happen pretty much every decade for the last century. In fact, the longest period in our modern economic history without a recession was between the 2008 crash and the 2020 pandemic. That was the longest period in our modern US history without a recession. So what does that mean? If you plan for the worst, prepare for the best, well, if you prepare, you can capitalize on recessions, because recessions create more millionaires than any other time. Market crashes create the opportunities to build huge amounts of wealth in a short period of time, because when you have these economic slowdowns, investments, assets go on sale because people are panicking. They never saw it coming. They are blindsided by this recession that nobody knew was going to happen ever. And people start panic selling, and you see good investments drop down. And sometimes you can buy these investments for pennies on the dollar. And if you're prepared, well, now you can be the one that comes in and buy these investments for a huge discount. But that requires you to be prepared when times are okay. So prepare for the worst, plan for the best, be ready for good times, but also be ready for bad times as well. Now, one thing is that financial side, but that also means the practical side of preparing for the worst. Have insurance. Business insurance if you own a business. Landlord's insurance if you're investing in rental properties. There's a lot of different types of business insurances. Protect yourself. Get health insurance. Get life insurance. Not all life insurance is good. Some I prefer term life insurance, not whole life insurance. Term life insurance, I look at it like a bridge insurance where I don't have the assets to support my family if I were to die tomorrow. And so I want life insurance for 10 years until I can build my wealth, or 20 years, whatever it might be. I prefer that type of term insurance. If nothing happens to you, you don't get anything, but you also save a whole bunch of money on the insurance payments, because I'd rather you invest your money, build your assets, and not have to rely on an insurance company to build your wealth. But that's just me. People have different opinions. Make whatever other opinions you want. Number 9, find the opportunity in the bad. And there are so many different ways to do this. Like the most obvious are when you see a stock market crash, some people lose a lot of their wealth. You see some people lose their retirement funds, people lose their life savings, but that also creates opportunity for you to come in, buy good investments for half off. That's the opportunity in the bad. When the 2020 pandemic hit, people were losing everything when the stock market was crashing. And some people were coming in and buying for pennies on the dollar. When the 2008 crash happened, people lost everything. People lost their homes. But real estate prices were then also selling for huge discounts. When I started investing in real estate, it was after the 2008 crash. It was around 2011 when I started investing in real estate. I'm in Michigan, not currently, but I was in Michigan then. And I was buying real estate for literally 90 to sometimes 92, 93% off. And it was because, well, there was bad things going on, but it also created opportunities. It's the same thing in business. Be able to find the opportunities in the bad. I had, when I was starting Minority Mindset, I'll give you that example. I started off Minority Mindset just with an Instagram page. And the Instagram page grew to around, I think it was about 17,000 followers. I think it was actually 17,400 followers. And we didn't really have any other presence. I was thinking about starting a YouTube channel. I had like a couple videos here and there, but it wasn't anything significant. some YouTube videos, and my Instagram page got hacked into and essentially deleted. I lost access to my Instagram account. Now, I had spent a lot of time building this Instagram and just talking about the stuff that I talk about, financial education and entrepreneurship and all the things that I wish I would have learned when I was getting started. And when that got hacked and deleted, I realized I needed to have more of my own personal brand, because you could delete my followers, because back then, Instagram, this is like, 2015, 2016, like that time, where Instagram was a very different place, and you would just post other things. Like I was posting images of other things and writing about it, so people didn't really know who I was. And that's when I was like, you know what? I need people to know who I am. That way I can protect my brand even better from things like hackers. So that was a big motivation for me to start making YouTube videos and start talking, right? It was an opportunity which was then created out of that hacking. So it's all about now, how do you find the opportunity in the bad? In fact, the reason why I started Minority Mindset at all was because I got scammed. In a previous company, I was running an e-commerce company. I got scammed when I was running that company, and I was so fed up from dealing with scams and just crap because I didn't have guidance as an entrepreneur. So when I got scammed for that time, which was, now I've been scammed many times after that, or since before that, after I got scammed running my e-commerce company, I was so fed up that I started this thing called Minority Mindset to help other people not get screwed over the way that I was. And that then grew to what it is today. Finding the opportunities. Bad things happen. It's life. But how do you find the opportunity? Even in manure, right? You can grow some of the best fruits with the nastiest manure. So it's finding the right opportunities in the manure. And I don't know why I gave that example, but you get the point. And finally, mindset shift number 10. I don't even know if this is a mindset shift, but more of just a mindset, is grit. Grit is the ability to get punched in the face, to get knocked down, to get screwed over, and continue to get back up and keep going. This is one of those traits that you see every successful person have. And this is going to be whether, again, you're an entrepreneur or not an entrepreneur. You have to have grit. If you're working a job, you need to have grit, because guess what? Even working a job, you got to deal with a whole bunch of crap. You got to deal with the company politics. You got to deal with everybody else's crap. And then when you're working to build your wealth, you got to take the money and you got to invest it. And that means you got to deal with the crap of investing. That means you're going to have to deal with the down market cycles. You got to deal with the bad investments that you got to make. That means you might have to deal with bad tenants. You have to deal with all the crap that comes with putting your money to work. Losing money is a part of the process. The goal is to make way more than you lose, but every investor loses at some point. But you have to have the grit to not start crying and complaining and just give up when that happens. Just getting back up, doing it again, learning, doing it again, learning, doing it again, learning. When it comes to building a business, it's the same thing. Building a business is hard. And every step of the way, you got different challenges. Making your first $10,000, that's hard. And that's a completely different challenge and skill set from going from $10,000 to $100,000. And you might think, oh man, when you make 6 figures a year, it all gets better. No, go from $1 million or 100,000 to $1 million. Now you got a whole new set of problems and challenges. Go from $1 million to $2 million to $5 million, and a whole new set of challenges. But you got to have the grit to keep getting up, even when things suck, even when it feels like the whole world is against you, even when it feels like everybody hates you, even when it feels like everybody's talking crap about you, even when it feels like nothing is going right, to keep getting back up, putting in the reps, putting in the work, doing what it takes, because that's what you want to do to get to your goals. That's what grit is. And that's, unfortunately, I don't think it's a mindset. This is really a lifestyle. But if you want to build that level of wealth, you got to be willing to put in that level of grit. Most people don't want to believe this, but you don't need to make a lot of money to become a millionaire. If you can invest $4 a day, or even just $100 a month, that's less than $4 a day, you can become a millionaire. Numbers have showed us this from history. If you can invest $100 a month, that's less than $4 a day, and you can get an average 10% return on your money a year, and you do this for 46 years, you will retire a millionaire, which means if you start at age 21 and you start investing $100 a month and you never invest another penny besides the $100 a month, you will retire a millionaire. Now, the first question you're going to ask is, but Jaspreet, where am I going to get a consistent 10% return? Well, if we look at history, the S&P 500, which is the largest 500 companies in the stock market, have on average over the last century grown by around 10% a year. Even though we've seen recession after recession after recession, even though we've seen market crash after market crash after market crash, on average, even despite all these downturns in the economy and the market, the S&P 500 has still grown on average by 10% a year over the last 50 years, over the last 100 years. Now, you don't have to go and invest individually into each one of these companies. There are funds that will allow you to invest into something like the S&P 500. Again, the S&P 500 is a group of the 500 largest companies on the stock market. If you go to your stock brokerage, I'm not telling you what to invest in, I'm just giving you an example. Always do your own due diligence. Never trust a random guy on YouTube. Investing has risks. You understand all that. If you went to your stock brokerage and you bought shares of SPY or VOO, as a disclaimer, I own shares of VOO. Both of these are ETFs that give you exposure to the S&P 500. So now, if you were buying the S&P 500, $100 a month from the day you turned 21 to the day you turned 66, you would have retired a millionaire on that $100 a month. Now, of course, yeah, this is looking back in time, but that's what would have happened if you made those small incremental investments, which is why it's so important to get started, even if you don't have a ton of money to start, because most people have the ability to put aside $4 a day. Now, your next question is going to be, but Jaspreet, by the time I'm 66 years old, $1 million is going to be nothing. And sure, $1 million today is going to be worth more than $1 million in 30 years or $1 million in 20 years. You're 100% correct. But you also have to remember, I'm talking about investing $4 a day and never adjusting how much money you invest. If you start with $4 a day today, $100 a month today, and then as your income grows, you also start investing more money. Let's say you start investing $100 a month today. Next year, you invest $105 a month. The year after that, $110 a month. The year after that, $120 a month. Guess what? You're not going to have $1 million when you retire. You're going to have more than $1 million. So yeah, the value of $1 million is going to adjust with inflation as time goes on, because inflation is still here. Inflation is going to be around today and 10 years from now and 20 years from now and 30 years from now. But you can also work to match that by also increasing how much money you invest. So now the question is, well, what's holding so many people back? And this is where we have, well, a lot of things happening. Number one, it is no longer access to technology, right? I mean, we have so many tools now in our tool belt, that allow people to start investing their money very simply. That's the great part. I love that part about fintech, is that investing has become so accessible for the average person, for anybody, that anybody can start investing with as little as even $1 now with some apps. The downfall now, the double-edged sword to this is people have access to this financial technology to start investing, but the financial education is lacking. And this is where now people get caught up in the wait. You're telling me that if I invest $100 a month for 46 years, I'll become wealthy. But if I put $100 into this meme stock or into this cryptocurrency or into this particular thing that's going to boom in 6 months, I could 10x my money way faster, and I don't got to wait to become wealthy over the long term. Now we have the exciting and the attractive and the fun side of investing, which really isn't investing. It's trading, it's gambling, it's speculating. Look, there is a place for trading. It's not for me. I don't trade. I don't know how to trade. I've tried trading before. I spent a lot of time trying to figure that out, and I didn't make any money. In fact, I don't even know if I lost money, but I probably lost a little bit of money doing that, but I lost a whole lot of time. Over the long term, what we have seen again and 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 again are the investors. The long-term investors are the people that will make more money over the long term, period, over traders. When times are good, the economy is booming, money is flowing, interest rates are low, everything's going up, traders will make a lot of money. We've seen that happen. And then that's when people get attracted to, wow, this person made so much money on this trade. Wow, I can't believe how fast you made that much money. Wow. Do you think I should come into? Do you think I can make the type of money too? And that's what gets a lot of people excited to start throwing their money into things that they don't understand, whether it's cryptocurrency, whether it's meme stocks, whether it's other stocks, whether it's penny stocks, whether it's anything. People will start throwing their money into things before they understand them. Because you think, What if I can also see those big returns? But the reality is, those returns are fleeting. If you get in quick enough and you sell before it busts, yeah, you can make a lot of money. But it's a game, and this is an active game, and it's a game that most people will lose money in. And that's where now you have to understand the right way to do it yourself. Now you might be saying, but Jaspreet, don't you invest in cryptocurrency? Yeah, but I'm not trading. I understand a different way of investing, right? I buy cryptocurrency every day, and it's a small piece of my portfolio. It's the speculative part of my portfolio. And so for me, I don't look at buying my investments like a trade. I'm looking at things 10 years down the road and what this will be worth to me then. And I don't advocate anybody to do what I do. I want you to take your own education and invest in what's important to you. So now, if you can become a millionaire with as little as $100 a month, and you can make even more money if you invest more money, the next question is, well, what's stopping people? So it's not the technology. Now we talked about the financial education. The last thing is, well, do I really want to wait that long? And now we get into this whole investment overload, this education overload. And it's the same with so many industries, right? The good part about social media is now you have access to unlimited education for free. You can go and learn about how to lose weight. You can go and learn about nutrition. You can go and learn about money. But there are so many opinions. In the health and fitness space, there are so many opinions about what's the best diet. Is it vegan? Is it carnivore? Is it keto? Is it whatever, intermittent fasting, whatever the other diets are? There's so many options. And so if you're just getting started and you start learning about all these options, you can very quickly be overloaded with it and say, you know what? I'm just going to stick with my donuts and cream cheese and I'm going to be good with that. We see it happen all the time with money, where people start looking at all their options. Okay, I got ETFs. That looks cool. Oh, index funds. Oh, what about mutual funds? Oh, real estate. Syndicate real estate deals, crowdfunded real estate deals, private equity deals, lending money. Oh, and now all of a sudden you get bombarded with all this information. And then you have a lot of people saying, you have to invest in this one thing. This is how you build wealth. When most of the times when people are telling you have to invest in stocks, or you have to invest in real estate, or you have to invest in options, most of them have their own agenda as to why they think there's nothing else out there. In reality, you can invest in whatever it is that you want, assuming it's a good investment, right? You can invest in stocks and build wealth. You can invest in real estate and build wealth. But you have to find the right option for you. And the mistake that so many people make, and the reason why so many people don't become wealthy from their investments, isn't because they made the wrong investment. It isn't because they invested into something with the wrong expense ratio. It's because they never got started. There are 3 factors that will determine how wealthy you will become from your investments. It is number 1, time. How long do you invest your money for? Number 2, dollars. How much money are you investing? And number 3, return. What is the return that you can get on your money? You can work to improve the return, and you can work to improve the dollars. The one thing that you cannot change is time. We cannot go back in time and start investing 10 years ago, but we can get started today. That is the one factor that we cannot change. And that's why it is so important to just get started. You don't have to make a commitment, a life commitment today with your investing strategy. You can start investing in ETFs today and then 6 months later say, you know what, I'm going to invest in index funds, or I'm going to invest in mutual funds, or I'm going to invest in real estate. That's okay. You will change because you're going to learn. You're not going to know everything going into it, but you have to get started. Time is the only factor that you cannot change. You can change how many dollars you invest, because what happens to a lot of people is you start investing and you get into this whole game of, oh, wow, I'm starting to understand this. I'm starting to see that light at the end of the tunnel. I'm starting to see what it would be like to compound my money. You start playing with those compound interest calculators online, and you start to see what it would be like for your money to compound. And that's when you say, I need more money to invest because I want to put some fuel on this fire. And that's a great feeling when you get there. The first thing that a lot of people do when they get there is you stop eating out. You stop going on vacations. You stop spending money. And, that's something I think most people need to do in the beginning, that you know how to live below your means, know how to make those sacrifices. But then the next thing is, how do you work to earn more money? And the reason why you're working to earn more money now isn't so you can drive a faster car or a bigger home like most people are doing. It's so you can invest more money. So yeah, you can change how many dollars you invest, which will impact how wealthy you become, because the more money you invest, the wealthier you can become. But then the third factor you have to also work on is the return. How can you get the highest return? Now, the way you can get the best return is, number one, you start building that financial education. You learn how to make better investments. You learn how to, make better things, make better decisions with your money, that we can get a better return, but also pay less money in fees. That way, more of that return goes in your pocket. So you can work on the return side. You can work on how much money you invest, but you cannot change how much time you have, which is why you have to get started sooner rather than later, because the longer your money has to compound and grow, the bigger your wealth will be. And the most difficult part about this is that concept of delayed gratification, because again, in today's society, when we want something, we want it today. When we want a luxury handbag, we want it today. You buy it with 0% APR. You buy it with a no interest credit card. You buy it with buy now, pay later. It is so accessible to have whatever we want right now, and that is what got a lot of people into the tough financial places that they are today, because we want convenience. Amazon was built on the whole concept of convenience, where now I don't have to go to the store to buy something. I can buy it online. Now, don't get me wrong. I love shopping on Amazon. I barely go into the store. I don't like going into stores to shop because it's a waste of my time. I love this idea of convenience. But the whole model was built on convenience. And now it's one-click purchase. You want to buy a new laptop? You can buy it with one click. You want to buy a new microphone? Buy it with one click. Getting whatever you wanted has become so convenient. And then came, okay, you want to buy a laptop you can't afford? No worries. You don't have to afford the laptop. You can buy it, pay it later. You can pay it in installments. And this is where now the convenience is starting to impact people's finances, because now we're saying, all right, you can go and spend whatever it is that you want. Just worry about the price later. And there's a reason why buy now, pay later, 0% APR are so profitable, right? Buy now, pay later, as I like to call it, broke now, broke later, is one of the fastest growing fintech industries out there. Why? Because there's such a big demand for it. Why is there such a big demand? Well, number one, inflation is still extremely high and the cost of living has gone up so quickly. And then number two, people love having things now. We want to have things today, and that has caused the boom of things like buy now, pay later. But now let's think about this for a second, because the whole idea is, or the marketing pitch is, 0% APR. You don't got to pay any interest for this. And so what a lot of people think is, I found a special loophole that I can have more stuff today. It doesn't have to cost me anything because there's no interest, and I get to have all the nice things. So I found this little loophole in finance. But let's think about this for a second. There's a cost to money. There's a cost to borrowing money. Because, if borrowing money was free, banks would not charge you interest to get a mortgage. So if businesses or these buy now, pay later apps are giving you money for free with buy now, pay later or 0% APR, how are they making money? Well, they are making money. In fact, it is extremely profitable. So how? Well, the first thing is they know that if they can sell you a computer on buy now, pay later, you might also buy a mic with buy now, pay later, because you don't have the pain of paying, $3,000 for these laptops now. So now you might buy a mic to go with it. Maybe you'll also buy a camera to go with it. Maybe you'll also buy a handbag to go with it, because now you can buy all these things on buy now, pay later, and instead of paying that $3,000 up front, you can just pay $100 a month for each thing. You don't have the same pain of that money leaving you, so you're going to end up buying more stuff. So the first thing is buy now, pay later encourages people, and statistics show this. The majority of people will buy more stuff. Number two, it's, okay, so now I start buying all these things, and then I have all these monthly payments. If I don't pay it off in the 9 months or 18 months that's given to me, I'm now going to be slapped, not with a 5% interest rate, but with a 28 or a 35, maybe even a 39% interest rate. And so now all of a sudden, buy now, pay later went from this, it's a special loophole that allows me to have more stuff without paying more money, to I am paying so much extra to buy all the things that I didn't know that I didn't need, that I couldn't even afford in the first place. That's why these programs are so profitable. And this is where now you have to make that decision. What do you want first? Do you want the nice things, or do you want the wealth? And if you're watching this video, I know what it is that you want. You want that wealth first. So you have to switch the way that you think, because the reality is the majority of people will never understand this, right? We're raised in this consumerism culture, and it's very unfortunate. And if you want to break out of that, the first thing you got to do is you got to change your mindset as to what it is that you want and when you want it. Now, when you can change your mindset on the way you spend, you can change your mindset on the way that you invest, because it goes hand in hand. It is your brain strings work the same way when it comes to long-term thinking. If you want to have all the nice stuff now, what makes you think that you're going to be able to invest for the long term and build your wealth that way? If you want all the nice stuff now, you're going to want to invest your money and grow it the same way. And what ends up happening is when you want the quick returns in your money, well, you're probably going to be the one that loses your money and pays for somebody else's long-term gains. And so now you lose both ways. And then you start hating the investing game. You start hating the system. You hate Wall Street. You hate corporations. You hate banks. And you just get into this whole system of just working to pay your bills and never wondering why you can never get ahead. But it starts with your mindset now. If you want to break out of this system and really build true wealth for yourself and your family and your community, and build true generational wealth, it starts with your mindset. Where now, okay, when I spend my money, I'm going to spend what I can afford, meaning money that's coming out of my pocket with cash, not going into debt to buy these things. Now you understand, okay, yeah, maybe I can't buy the nice laptop today. Maybe I can't buy the nice stuff today. I got to downsize because I want to be able to afford it with cash, especially when it's liabilities, something that's not making me any money. You got to make sure you're not buying things that you cannot afford. The simplest thing you can do is follow something like my rule of 5, which says if you can't buy 5 of them, you can't afford 1 of them. Then you reframed your spending. Now you're going to start reframing the way you invest. Now you're going to understand, okay, we're working the long game here. We're working to build that wealth now. Okay, I can build wealth. I can become a millionaire with $100 a month if I have enough time. I need to just get started. And this is where now you start investing. And again, there are so many ways to invest, but you got to just get started. Start doing your research, start reading books, but also get started by putting your money aside to start investing. Then as you do that, that's when you start learning. And as you start to learn, maybe you'll change your investing strategies. Maybe you'll say, I want to invest in stocks instead. Maybe I want to invest in individual companies instead. You will start to learn, but you have to start building that discipline, because now investing is a long-term game. The people that build the most wealth are not the people that hit something quick, that hit the lottery in the stock market. It's people that are working to build long-term wealth. There's a saying this about Warren Buffett, who says when the tide goes out, you see who's been swimming naked. And what that means is that when the free money, when the economic boom goes away, you see who's been living this fantasy lifestyle where they've been living high off of the economic boom. But then when you see that money and that whole system start to slow down, those people are the first ones to lose everything. And it can be very easy to fall into that trap because it's a very emotional thing. Oh my God, yeah, why would I want to wait to get rich when I can get rich now? I mean, get rich slowly is not a very attractive term. If you had the option to get rich quick or get rich slowly, 100 out of 100 people would pick get rich quick. But the reality is most people don't. The vast majority of people will never get rich quick. It's get rich slowly. Yet we get attracted to the get rich quick because our emotions go this way if our mindset is not wired to understand that this get rich quick is probably going to fail. We look at the opportunity, but we never look at the risk on the get rich quick. But what's interesting is when we look at the get rich slowly, now, instead of looking at the opportunity, we're looking at the risk. The risk is, man, that's a long time from now. What if it doesn't work out? What if $1 million in 40 years isn't worth as much as it is today? So instead, we take all the riskier options with a much lower potential to actually succeed. So yes, you can become wealthy, even if you don't make a ton of money, even if you don't know a lot about money, even if you don't know how to invest, as long as you get started and you can invest your money for long enough. And then as you do that, you keep learning. And as you learn, you apply what you learn. And as you make more, you also work to invest more. The more you invest, the wealthier you become. Remember, there's 3 things that will determine how wealthy you become: time, dollars, and return. As you make more, you can invest more dollars. The sooner you start, the more time you have. The return, how fast your money grows, is going to depend on how you learn, how you can minimize fees, and how you can grow the investments that you're making, right? This is all about the speed of money. How fast can you grow your money? And the way that you can grow your money faster is by learning more about money, learning more about investing, building that financial intelligence, building that financial education. That way you can go out and get better returns on your money. If you are in your 30s and you want to figure out how you can start investing, it is not too late, but you need to get started ASAP, because there are 3 factors that will determine how wealthy you will become. Number 1 is how much money you invest. Number 2 is the return that you get on your money. And number 3 is the time, meaning how long that you can invest your money for. So for example, if you invest $300 a month and you can get a 10% annual return on your money, and you do this for 30 years, you might be able to retire with $650,000. But now let's change it up a little bit. If you can invest the same $300 a month, you get the same 10% annual return, but now instead of 30 years, you invest for 35 years, now you'll be able to retire with over $1 million. Now, the one thing you can't do with time is go back. You can work on increasing how much money you invest by working to earn more money, and you can increase how much return you get depending on how you invest your money in your financial education, but you cannot change how much time you had ahead of you. This is where now it is so important to get started today. And that's why I want to go over a couple different investing strategies that you can start considering. Now, again, I am not a licensed financial advisor. If you have questions, talk to a licensed advisor in your area. But there are 2 general categories of investments that you can make, especially in the United States. Number 1 is by using a tax-deferred retirement account. And number 2 is by using a taxable retirement account. A tax-deferred retirement account would be doing something like a 401k, a 403b, a 457b, or an IRA. Now, for all intents and purposes, a 401k, 403b, 457b all work essentially the same, and I'm going to lump them all together, and then I'm going to talk about the IRA. The whole idea behind these tax-deferred retirement accounts is you're going to get a couple benefits. Number 1 is you get the benefit of getting some tax deferrals, and number 2 is you get the potential benefit of an employer matching your investment. Meaning, if you put $1,000 into your 401k, your employer might give you an extra $250, maybe an extra $500, maybe an extra $1,000 just for contributing money into your 401k. So if you get that benefit of an employer match, there's a lot of powers, kind of like free money that you're getting by doing that. But there's a lot of cons with 401ks and IRAs, but I'm going to get to that a little bit after. But this is a great place to start, especially for a beginner investor. If your goal is just to build up this retirement fund, start by putting the money that your employer is matching. So if your employer is matching you up to a certain amount, do that at least to get started, and then you can decide later on if this is something you want to continue with or not. But get started at least with that employer match. Now, the whole idea between the idea with a 401k or an IRA is you get this benefit of being tax deferred. And what that means is either you can pay taxes today and not pay taxes in the future, or you cannot pay taxes today and then pay taxes in the future. So if you go out and you get a traditional 401k, you don't have to pay any taxes today on the money that you invest. So if you got paid $1,000, you put all $1,000 into the 401k. It's a traditional 401k. You don't have to pay any taxes on the $1,000 that you invest. On all the rest of your income, you got to pay taxes on it. So now, instead of paying, say, $200 in taxes, you get to invest all $1,000. Now, this $1,000 can grow over the course of your career. And then when it comes time for you to retire at 65, 67, 70, however old you might be, now you get to pull this money out. Because you started with more money, the goal is that you're going to have a bigger nest egg because you don't have to pay any taxes in the beginning. But then on the back end, you're going to have to pay taxes when you pull this money out. So if that $1,000 becomes $2,000, now you got to pay taxes on all $2,000. Now the question is, how much are you going to pay in taxes? And this is where it's a little bit of a question mark, because on one hand, the idea, the thing that everybody says is you are going to have less income when you retire, so your taxable income is going to be lower, right? Because we have a marginal tax rate. The more money you make, the higher your tax rate is. And so everybody says, well, when you're 65 or 70 years old, you're not working, so you're not going to have a lot of income, so your income is going to be lower, so your tax rate will be lower. On the flip side, you don't know what the tax rates are going to be when you're 65 or 70 years old, because, well, there's a good chance that tax rates could potentially go up. Why? because number one, the United States government has a massive amount of national debt. Number two, we're still running a pretty large government deficit, meaning we're spending more money than we're bringing in. And so all these things could contribute to the government needing more tax dollars in order to continue funding their operations. And the third thing, which is probably one of the biggest factors for me, is why would I want to have less income when I'm older? If I work to build my investments correctly, I'm going to have way more income in the future because I'm working, even if it's not my own business. I'm going to just assume that I don't have a business right now. I'm going to be working to stack my investments, to stack my cash flow. Every year, I'm working to build more and more and more cash flow. I am buying more cash flow producing assets year after year after year, which means by the time I'm 65, I'm not hoping I'm going to have no income. I'm hoping I'm having a lot of income, which means I would have a big taxable income. Now, that's me. You got to figure out what is going to be the best situation for you. That's how a traditional IRA or traditional 401k works. The Roth is a little bit different. With the Roth, if you wanted to invest $1,000 into your 401k or IRA, the first thing you're going to do is pay taxes on this money. So if your effective tax rate is 20%, you make $1,000, but $200 to the IRS. Now $800 gets invested. Now with this $800 gets invested, this money can grow. And if it again doubles to $1,600, now you get to pull this money out generally tax-free. Now, in the other example, you got to pull out $2,000, but then had to pay taxes on it. In this case, you pulled out $1,600, but don't have to pay taxes on it. And the question is, which one is going to be better for you? Would you rather have $1,600 tax-free or $2,000 as taxable? And this is really a question of personal preference because, again, we don't know what tax rates are going to be in the future. Are they going to be higher or are they going to be lower? And second, what is your income going to look like? Are you planning on having way more income in the future, or are you planning on having less income in the future? That's the first question you have to ask for yourself. The second thing, when it comes into the actual how-tos of investing in your 401k or your IRA, is where can you actually invest your money? When you invest your money into a 401k, a company-sponsored retirement plan, you're generally, especially if you're working for a smaller company, going to be limited to where you can invest your money. So you're going to have generally limited investment options, and sometimes you might be stuck into paying really high fees for your investments, which means if you are somebody who likes managing your investments, you like investing your money yourself, you might not have the same investment opportunities. You might have to pay higher fees. You might not have the same return potential as if you invested this money yourself. So this is where, again, I'm not saying don't go out and do this. Get started. This is an easy way for you to get started with your investments. And it's an easy way to get some free money with the help of your employer match. Get started here. As you start with your 401k or your IRA, then I want you to start doing your other investments on the side and figure out what you like better. Now, IRAs are a little bit different than 401ks. I'm still going to talk about them. But this is where start with your 401k, see what you like, see what you don't like, and see if there are better opportunities for you elsewhere. With the IRA, you tend to have more flexibility because an IRA is not through your employer. The IRA is something that you get to control yourself. So you generally have more investment opportunities. You have traditional IRAs and Roth IRAs that work the same way as a 401k. But with an IRA, you have the ability to be much more hands-on with your investments. You also have some IRAs that will allow you to invest in real estate because pretty much all 401ks and most IRAs will require you to invest that money somewhere, somehow in the stock market. But there are some exemptions in IRAs that will allow you to invest your money into real estate. So you have a little bit more flexibility there. And now it's just a matter of figuring out, is the tax deferred benefits with an IRA worth it for you or not? Now, again, I'm not a huge fan of the tax deferred retirement accounts because I like being able to control my investments, and I like the ability to touch my investments, and I like the ability to get the cash flow today. That's just the way that I look at it. So for me, those tax benefits are not necessarily worth it because I'm also a big fan of real estate investing, and real estate provides some of the biggest and best tax benefits that our tax code has to offer. And I can tell you this as an attorney who's not your attorney, but real estate allows you to, number one, generate cash flow on your investments, because now I can go out and buy a property. I can buy a single family home. I can buy an apartment complex. I can buy a mixed use building, but I can buy this building that I will then rent out to other people. When other people live in or use my property, I will get rental income. Now, if I do it correctly, this rental income will pay for my expenses. It'll pay for my property taxes, my insurance, my mortgage, my maintenance fees, my management fees, and any debt if there is any, and then put some money in my pocket. Now, generally, this income that I get is taxable, but real estate has this special exemption called depreciation, which says that because your property is 1 year older, you get a tax write-off on your income. So now you might get to say, hey, IRS, I generated, say, $10,000 in income from this property, but then you get to subtract this depreciation. Now, the amount of money you subtract is going to depend on how big the property is, but this is where you hear of some very successful real estate investors making millions of dollars a year, paying little to no money in taxes legally. It's because of the depreciation deduction. Because they made income, they have their money in their bank account, but then they get to tell the IRS, because my property is a year older, I deserve this write-off. Even if the property value is going up, you get to still take this depreciation deduction. That's what the tax code says. And so now you can generate money and pay little to no money in taxes legally. And then the second benefit of real estate investing on the tax side is, let's assume that you buy a property for $100,000 and you own this property for a number of years. The area begins to boom, and now this property is worth $200,000, and you sell it. You just made $100,000 of profit. Now, generally, again, if you made $100,000 by selling an investment, that's taxable income. But with real estate, you have another tax deduction. This is called a 1031 exchange, which says you made $100,000 in profit by selling your property. If you take all of this $200,000, and this can be any amount of money, but if you take all this $200,000 and now you go out and buy a bigger property that's going to pay with more cash flow, you don't have to pay a penny in taxes today. And you can keep doing this again and again and again every year until you die and never have to pay a penny in this capital gain appreciation taxes. So now you bought a property for $100,000, sold it for $200,000. Then you could do it again. You buy a property for $200,000, sell it for $400,000. You sell that for $400,000 or $800,000. Now you keep flipping and flipping and flipping, and pretty soon, a number of years later, you're now in the millions of dollars. And it all started with your small $100,000 investment. Now, it's not always going to be sunshine and rainbows. There's a lot of headaches that are involved with real estate investing, but that's the idea, that you can get a lot of tax breaks with real estate investing. So now you have the tax deferred retirement accounts, which are the most accessible way for somebody to start investing. And this is where I would recommend that pretty much everybody start, because it takes the least effort. So get started here. But what I want you to remember is that this is not where your retirement planning should end. Even if you have a 401k and an IRA, I still want you now to invest in addition to that into the taxable retirement accounts, because now this is where you're going to be able to build true and real wealth. Most people assume that, I'm putting some money into my 401k, I'm getting my employer match, I'm all set, I'm ready for retirement. Well, you're going to be in for a rude awakening, because that's not going to be enough. You are going to have to invest your money yourself if you want to be able to retire wealthy and be able to live your life the way you want financially. So now, what is a taxable retirement account? Well, the first option, which I just talked about, is real estate. Now, the pros with real estate are everything that I just discussed. You get the tax benefits, you get the cash flow, you own a hard asset. But the cons with real estate are, it takes a lot of money to start investing in real estate. If you have $5,000 to invest, it's going to be very difficult for you to go out and buy a property yourself. Now, that doesn't mean that you can't get exposure to real estate, because if you have a few $1,000s, you can invest in crowdfunded real estate. You can invest in real estate syndicate deals, which means essentially you are getting exposure to somebody else's real estate deal. The way that you can do this is go to any real estate investor conference in your area. They happen all around the country. There's always going to be investors, developers there looking for money. Always. People are always looking for money to fund their deals. And if you invest in one of their deals, you're going to get a small piece of ownership in somebody else's deal. And if that deal grows and makes money, you're going to get your share of the profits. Of course, there's risk. You're never guaranteed to make money when you invest, but that's one way for you to get exposure to real estate without owning the real estate and buying it all yourself. One way to get started. The second way that you can invest your money into taxable retirement accounts would be through the stock market. Now, just like with anything else, there's a lot of different ways that you can do this, and you can go from very simple to much more complex. And if you just want to get started on the simple side, you can be a passive investor in the stock market. And this is where I believe that 90 to 95, maybe even 98% of Americans should be, because as a passive investor, what you're doing now is you're going to set up a system where every week or every 2 weeks or every month, every time you get paid, some money is going to automatically be invested into the market. And you're not investing in individual companies. You're not investing into Amazon or Tesla. You are investing in America. Now, all you got to do is every time you get paid, you're just going to buy a little bit more of America, period. And the way this works is you are going to buy some ETFs or index funds. These are funds that give you exposure not to one company, but to a group of companies. For example, I'm not telling you what to invest in, just an example. You can go out and invest in something like VTI. VTI is an ETF that gives you exposure to the total stock market. It's called a total stock market ETF. So now when you go out and you invest in that one ETF, you're getting exposure to our stock market. Well, what is in the stock market? The companies that make America, America. The big American companies, that's what's on the stock market. So now when you buy VTI, you're buying a piece of the stock market. Another one is SPY. SPY gives you exposure to the S&P 500. What is the S&P 500? Well, it is a group of the 500 largest companies on the stock market. So when you go out and you buy one share of SPY, you're buying a little piece of the 500 largest companies on the stock market in America. So now, if you were to build an ETF portfolio or an index fund portfolio, every week or every 2 weeks, or every month, some of your money is going to be pulled out of your checkings account when you get paid, and it's going to automatically be invested into America. Now, over the years, because this is not something you're going to do for 6 months, you're going to do this for years, if not decades, you're just going to keep buying a little bit more of America. That way now, as the American economy grows, your investment portfolio also grows. That's what passive investing is. I do passive investing. I have two strategies when I invest my money. One is passive investing, where every week I have some money that leaves my check-ins account and is automatically invested. Now, I invest into a lot of different types of ETFs. I invest into cash flow producing ETFs, to value ETFs, into emerging market ETFs, into innovation ETFs. So I have a whole portfolio of ETFs that I invest in, but you just got to get started. The mistake that so many people make is not that they invest their money into the wrong sector or into the wrong industry or into the wrong group or into the wrong expense ratio fund. It's that they never start investing. And once you get started, guess what? You can always adjust your investment portfolio. You can always adjust your ETFs. You can always adjust your ratios. But you can't adjust getting started. So you got to get started first. So now I have this passive strategy that works for me. And then I also have an active strategy. Now, active strategy is now where I'm investing into individual companies. This is a lot more work. This is where most people think it's, I'm going to find the next Amazon and I'm just going to throw my money into that. Or you try to find the next Tesla and you try to throw your money into that. For me, this is, I'm looking for what I believe are good companies that are undervalued that I want to hold on to for the long term. And this isn't a guessing game. This is much more of a research intensive game where I like to research companies, and researching companies is more of the feeling side. This is now I'm looking at who's running the company. What is the product? Do people like the company? What's the sentiment around the company? And what's the barrier to entry? This is what Warren Buffett calls a moat. Is it really hard for a competitor to come in and take this company's spot? Or is this company a real behemoth and they have a real brand recognition and a name recognition that's going to be very hard to compete with? Once you figure that out, then you get into the financials. You're digging into the balance sheet. The balance sheet is essentially the net worth statement of a company. You look at the assets and you look at the liabilities. What do their balance sheet look like? What do their assets look like? What do their debts look like? Then I look at things like the income statement, the profit and loss statement. How much money did this company make last year, the year before that? What are their operating costs? Are they rising? Are they shrinking? If they're rising, why are they rising? Are they rising because they're investing a lot more in their company? Or are their operating costs rising because the cost of doing business is rising? And so you have to start asking and start looking into these numbers. Then you look into the cash flow statement, which is, how is money flowing through the company? What is this company doing with their cash? Are they being smart with their money, or are they just getting rid of this cash and giving it away to shareholders too early? So these are the now analytical questions that you ask when you want to invest in a company. And again, you don't have to do this. Most people shouldn't be doing this. This is something that you got to be interested in. I like researching companies. I'm a money nerd, right? I'm a weirdo. I like doing that. To me, I enjoy it. So I don't mind doing it. But if you don't like the idea of learning how to do that, if you don't want to do that, if you don't want to spend the time to do that, if you don't have the time to do that, it's okay. You don't got to worry about doing it. You don't have to do that. The passive system is a great strategy that has been proven to build wealth decade after decade after decade. It doesn't mean that your investments are going to always go up. We see America go through recessions. We see our stock market go through market crashes. But if you invest long enough, you would have made money over the last century. And this is where now understanding, if you want to build wealth, you got to understand what your options are. The most accessible option is your retirement accounts. Get started there, but do not stop there. Your retirement accounts are not going to be enough for you to be able to live your life wealthy. Then, once you start there, you start doing the taxable accounts, stocks and real estate. And now you can make the third decision, which is, well, are these taxable accounts good for you, bad for you? It's okay if they're good. It's okay if they're bad. You just got to figure out what is the right strategy for you. And then, as you start building your investment foundation, that's when you can start looking at alternative types of investments. Now, this could be things like investing in startups. This could be things like owning a little bit of gold. This could be things like investing in potentially cryptocurrency. This is where now you can start looking at more of the speculative type of things, but you don't want to jump into these speculative investments until you built an investment foundation base. So now you start building your investment base. You have the retirement accounts, you have the taxable accounts, the non-taxable accounts, and now you can look at other things. I like investing in startups. I'm an entrepreneur. I like working with other entrepreneurs. I like researching these types of companies. I like investing in these companies, but it's very risky. Investing in startups is, well, you're going to lose money. 8 to 9 out of 10 startups will fail or go bankrupt within the first 5 years. Statistics tell us that. I'm going to jump back into the video in just 1 second, but before we do, if you are an investor and you're looking for an easy and free way to stay up to date on what's happening in the top financial news, from the economy to the housing market to the stock market to the crypto market to the global economy, then you have to check out Market Briefs. Market Briefs is my free financial newsletter that I created that will keep you up to date on what's happening in the financial news. You can read the newsletter in less than 5 minutes every morning. It's a fun and easy to read email, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below. So if you were to go out and invest in a handful of startups, most of them will fail. The goal is that you're going to hit one that will make up for all the losses. Will that happen? Who knows? But that's part of the game. I think it's fun. I also like the financial potential upside with it, and it's a learning game for me. It's something that I enjoy doing. Besides that, I also invest in cryptocurrency. Now, I have use with cryptocurrency. I've talked about how I use cryptocurrency to pay some of my contractors that are overseas. I like the power of the blockchain, but there's a lot of people that jump into cryptocurrency thinking they're going to get rich by buying some cryptocurrency and having it just pop overnight. That's why you see such huge volatility in cryptocurrency. That's why you see some people make a ton of money in cryptocurrency. And that's why you see most people lose their money in cryptocurrency. So if you're going to invest in cryptocurrency, number one, make sure you can lose all that money. You're okay losing that. But then second, also understand what is it that you're buying. Are you comfortable with that investment? And are you comfortable investing in it for the long term? Number three, you can also look at owning precious metals, something like gold. I own gold. Gold makes up a small piece of my portfolio. It's about 2% of my entire investment portfolio. Why do I invest in gold? I look at it like a way to save hard money. If I were to go out and take $10,000 worth of gold and $10,000 worth of cash and bury it in my backyard today, my theory is that 10 years from now, the gold is going to have more buying power. So I own a little bit of gold. but it's not a huge piece of my portfolio. My gold doesn't generate me any cash flow, and I don't sit here and monitor the price of gold. It's just an alternative way for me to save money. It's another small piece of my investment portfolio. So now, when you build your investment portfolio, understand the investments that have been around a long time, that have been proven to build wealth. Make that the bulk of your investments, and then as you master that, you can start looking at other alternative investments, but start with the things that have been proven, stocks and real estate, and then you can start diversifying into some of the other asset classes as well. If you have $10,000 in the bank right now and you want to grow your $10,000 to $100,000, most people think that you have to just keep working to earn more money to grow your 10 grand to $100,000, but that's not the only way that you can grow your money to $100,000. And today I'm going to be going over 5 different ways that you can grow your 10 grand to